Investors cheer Fed's transparency, dollar confused. Global stock markets attempted to rebound at the start of the week but came back under pressure as virus-related worries resurfaced amid rising cases globally. The spread of the Omicron variant deterred buyers ahead of key central bank meetings. As a result, Wall Street stocks slipped from all-time highs amid profit-taking, with tech-heavy Nasdaq index losing nearly 1.5% on Monday. In Asia, the MSCI's broadest index of Asia-Pacific shares outside Japan was down almost 0.5% after authorities detected the first Omicron case in mainland China. The next day, U.S. equities extended losses as fresh inflation data showed a rise in producer prices to record highs. The PPI jumped 9.6% year over year in November versus 9.2% expected. On a monthly basis, the index rose 0.8%, also above the 0.5% expected. Investor tone was also pressured by a warning from the World Health Organization that a new COVID Omicron variant is spreading faster than any previous strain. The variant is probably present in most countries of the world, the organization added. Meanwhile, Shanghai Composite fell 0.38% even as China's National Bureau of Statistics said that the country's economy has continued to improve in November. Still, fresh data showed that Chinese retail sales in November rose 3.9% year-on-year, below the expectations of 4.6%. In a sign of some improvement of risk sentiment, European indexes closed mostly higher on Wednesday. The Pan-European Stock 600 added 0.3%, with tech stocks leading the gains. However, the FTSE 100 gave up early gains and shed 0.66% after the UK reported a record number of new daily COVID-19 cases. On the data front, UK CPI rose by 5.1% on a yearly basis, up from 4.2% in October, the steepest incline for a decade. In individual stocks, coal-rich shares plunged over 9% after the Belgian company revealed its first half results. The retail group said its profit decreased by 1/3 as a result of increased price competition. The turnover of retail activities decreased by 2.7%, while the turnover fell 0.2% in the first half of the year. Wall Street saw a downbeat start to trading Wednesday ahead of the Federal Reserve's policy announcement. Also, the data from the U.S. Census Bureau showed that retail sales rose by just 0.3% month over month in November, below market expectations for a rise of 0.8% and the 1.8% previous result. Core retail sales growth also missed, coming in at 0.3% versus forecast for a growth rate of 1.0%. The Federal Reserve left the federal funds target range unchanged at 0.0 to 0.25%, in line with expectations, while the pace of the taper bond buying program will be doubled from mid-January to $30 billion per month. The new dot plot indicated 3 rate hikes in 2022. The GDP growth forecast for next year was revised slightly higher to 4.0% from 3.8%. Speaking in his usual post-Fed meeting press conference, Fed Chair Jerome Powell said that economic developments and the outlook warranted a faster pace of bond taper. He also admitted that rising COVID cases in recent weeks and Omicron pose risks to the outlook. On the positive side, Powell noted that with improved job market conditions, the economy has been making rapid progress to its goal. Following the meeting, U.S. stock indexes reversed early losses to turn positive as the decision was in line with expectations, while Powell's comments on the state of the country's economy helped somewhat calm down virus-related concerns. Meanwhile, after a bullish knee-jerk reaction, the dollar turned slightly lower versus high-yielding and commodity currencies. As such, the Euro-USD briefly dipped to fresh December lows but managed to hold above the 1.1200 figure and climbed marginally. Still, the common currency remains fragile and vulnerable as the market focus is now shifting towards the ECB policy meeting due later today. The central bank is widely expected to announce a decrease in purchases under PEPP of approximately 20 billion euros from January 2022. That is all for today. Thank you for watching. Please click subscribe to always be in touch with the latest market news.